You and I covered this, I think, in our last talk, which is using Fibonacci based on the gold super cycle. That long-term perspective has been hit. And now we're in what I call kind of like icing on the cake. I can tell you where the next kind of leg range is. So there's like 2.5 to like 4% upside potential for gold for this next run.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the EDGR mining guy over on X, and of course, you're a host of this channel. And I'm looking forward to welcoming back Chris Vermeulen. He's the chief market strategist over at thetechnicaltraders.com, somebody we've had on quite a few times on this channel, and it was time to get him back. So much volatility in the market. Just today alone, as we were recording this on April 1st, the U.S. market started out deep in the red. A lot of negative headlines came out, and all of a sudden we're in the green. So we'll have to get to the bottom of this. What caused this move? What's the sentiment like? Where's momentum right now? And of course, gold. Are we at the top of a blow-off top here? Have we seen the end of it, or is there more to it? What are Chris's next targets? We will discuss that here in a few short moments. Before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, bringing high-caliber guests like Chris onto the program. It's a free way to support us, and we tremendously appreciate it. Thank you so much for doing that. Now, Chris, it's great to have you back on the program. How you been?
I'm great, man. Spring is in the air here in Canada, so birds are chirping and it's muddy everywhere, but I love it. All's good.
No, fantastic. Yeah, it's gorgeous out here. I'm just in Zurich at a conference, and it's beautiful out. Trees are blossoming as well. Just gorgeous.
Nice.
Spring is in the air. Let's see if there's spring in the markets, and let's get a bit of a spring in our step here, Chris.
Yeah.
Let's start with a general overview of the markets. Like, what's the state of the markets before we dive into some of the specifics? What's the state? How are we doing?
Yeah, well, I think the state is looking pretty bleak. I think we finally have turned a corner. I mean, I've been bearish on the equities markets for a long time. And while I'm bearish, we've been long the markets, but I finally feel like the markets are turning around. There's a few different things coming into play. Gold has come to life, which it's really kind of rocketing higher. Usually it comes to life and has a very strong move just before a recession, just before a stock market top. We're seeing, more recently, momentum wise, Kai, is like we've seen huge panic selling on the stock market. We saw a big washout move that happened on Friday and Monday this week that kind of carried over, which is very signature of the levels. And you and I can dive into those charts in a little bit if you want. But more or less, the markets have really turned a corner. I think we've gone from a bullish state and some of the big sectors and stocks dragging this market higher. Now it seems like most stocks have lost their momentum. They actually have bearish chart patterns. They're trending lower, and overall, this market is refusing to bounce. So are the Magnificent Seven, and the fact that we don't have a resilient bounce at this point, to me, is a sign that momentum has been lost from a long-term investing standpoint. Meaning, I think the market has put in a major top, and we're going into a bigger recession that's probably going to last a couple of years. And from a short-term trader standpoint, there's a bunch of mixed signals out there. We're oversold, ready for a bounce, but the trend is clearly down. You shouldn't be picking a bottom. So, I mean, there's a lot of noise and volatility here.
Yeah, no, you'll help us definitely sift through the noise and find the proper signals, Chris. But maybe just one more fundamental question: economy versus markets. And let me just read the headlines. I read them to you as well earlier. It's just mind blowing a little bit to try to understand what is actually going on. The U.S. market was in the red all day. And then news come out about the U.S. manufacturing sector contracts in March, U.S. job openings below forecast, U.S. economic optimism index falls to 6-month low, and all of a sudden the chart just shoots up straight on the S&P 500.
Yeah.
Help me make sense of it a little bit, at least, Chris, because the economy and the markets are two different things, obviously, but yet they react when news come out.
Yeah, they are. You can't really read one and think it's going to affect the other one. It's really a crapshoot. I would think something else has triggered to cause the markets to move. But on the flip side, a lot of times people have already factored in a lot of this news. Buy on rumor, sell on news, or in this case, sell on rumor and then buy on the bad news, which is kind of what's happened. I think people are already starting to get a little bit bearish. And the news finally comes out and it's bad, but it's not as bad as they thought, or it's not the end of the world. And then people buy. Just like when we see earnings for companies, Nvidia comes out with stellar earnings, growing by leaps and bounds, but it doesn't make enough money for the investors still, and so the shares sell off on good earnings. So you really have to separate the two. You either follow price action and focus on making money by following the money, or you follow the news and you're going to be way offside on the wrong side of most trades, doing that emotional news driven roller coaster, and watching your account kind of just not make any sense to what's going on in the news. You really have to separate the two. And that's what I do at the Technical Traders. I'm 100% technically driven. I do follow the news and the data, but it doesn't come into any of our trading. Usually what we're doing is the exact opposite of what the news is saying. So
This interview is sponsored by Yukon Metals, a company holding a highly prospective portfolio of gold, silver, copper, gold, and critical metals assets. Led by a seasoned management team and board, the company leverages strong technical, financial, and territory expertise. With the support of core shareholders like Keith Neumeyer, who helped put the company together with the Birdall family, as he did with Snowline Gold, Yukon Metals is diving into their 2025 exploration program with strong discovery potential. The company has focused on three high priority drill targets this season. Highlights include the Star River project, where they've uncovered bonanza grade gold and silver right at surface. The AC project hosts copper outcropping 6 kilometers away from the Alaska Highway, and the Birch project hosts a 1,400-meter long gold in soil anomaly, which the company interprets to be the surface expression of an intact copper porphyry. If you're looking to invest in a well-funded company backed by a strong shareholder base with district-scale potential, be sure to check out Yukon Metals, currently trading on the CSE under ticker YMC and the Frankfurt Stock Exchange under E770. To learn more, visit yukonmetals.com, and of course, always do your own due diligence. And now let's go back to the conversation. I was going to say, the news is not telling us that we're in a recession yet. Yet
no.
the market seems to predict one. What's the lag effect here? Once we realize that we're actually in a recession, do you see it? Is it easy to pinpoint on a time scale? For example, let's say 0 today, 6 months time. It's easy to predict.
Yeah, I mean, well, generally people want to see a decline in GDP for a quarter or two, and then they're like, oh, now we're in a recession. We've had two declining quarters. So I would naturally think there's at least 3 to 6 months delay in terms of economic data, but a lot of damage can be done to the price charts by the time we get to that. As we've already seen the stock market down 10, 15% from the lows, the highs to the lows recently. And we really haven't had any bad data. And this downtrend really, I think, is just getting started. So go another 5 weeks or 5 months from now, when there's confirmation like, man, things are bad and they've been bad again. Um, there's a big delay. Usually we can see at least about 6 months kind of from economic data to stock market. That being said, I do think data moves a lot faster now. People are a little more in tune with the market, a little bit. Well, they're more in tune, but most people don't know how to navigate it. So it might not be quite 6 months. It might be more like 3 or 4 months lead lag time. And you just don't know if the market is leading or lagging. And it's best not to try to time yourself around economic data because it doesn't help.
Yeah, no, I stopped predicting the gold price when it shot up like minutes before the US was pretty much bankrupt. And
Right.
so I was like, okay, it should go the other way, in my opinion, things like that. Whereas like it
Yeah.
doesn't make any sense. We'll just play it how we're being served. But you know, trying to pinpoint the market momentum and market moves, like we talked earlier, DeepSeek seemed to have been that one pivotal moment.
Yeah.
Was that easy as a trader to say, okay, this DeepSeek news was really, the pin in the cushion that really started the downfall of the market here?
I think, yeah, the first time we saw that big hit, I mean, it hit NVIDIA real hard. It just goes to show, I mean, the world is very competitive. If there's something good out, just give it enough time. Somebody's coming out with something better, right? It's NVIDIA felt like I think everyone thought NVIDIA was the company, and they realized, oh, you can have an AI that runs on a fraction of the power and can do something just as good or better potentially. Um, I think that definitely took the wind out of the sails in the AI space. And of course, NVIDIA is so big, it has such a strong market cap. Wherever NVIDIA goes is kind of where the market is going to get dragged. Um, and so I think that was a big turning point. I really do. You look at the semiconductors, you look at the Magnificent Seven, look at NVIDIA, they've gone from strong bull market phases to, over the past really like 6, 8 months, they've been putting in very volatile major topping patterns. And now the trends are down. They've broken key support levels. And there's just a lot of competitors coming out, and I think some of that excitement of the whole world and the hype of moving into AI and um, Nvidia is kind of losing its shine. And I think most people who are going to get into Nvidia and type of play, they're already in. In fact, they probably bought right near the peak. Usually, the final masses get in at the very last couple price points, and then the price usually drops after that. So I think DeepSeek, even though it's just news, I mean, from my perspective, it's just a competitor. I mean, you should expect that. Yet the whole world thought it was like AI is over in the United States, uh, but it's just a competitor. It shows how emotional and how sensitive traders and investors are when you fall in love with one company or one thing, and you're not open to there's going to be a flood of people trying to chip in on this, take part of this. It's should be expected.
Yeah. Before we look at the charts, Chris, maybe one last question here. Are valuations becoming more relevant again? Are people starting to pay attention now?
I think now that the market's pulling back, maybe it's starting to come back up. I have seen it mentioned a few times, but overall, I still think like most companies are way overvalued. Like look at Tesla. I mean, it's dropped 50% and it's still way overvalued compared to everything else, right? So I have learned a long time ago that economic data and fundamental data and PE ratios really mean a whole lot of nothing. I mean, you can't trade and predict off those things. They're going to lead, lag. They're all over the place. You really need to follow price. And I think whatever the ratios are now for a lot of things, I think they could still be cut in half. I mean, some of them a lot more than that. So it's best not to get caught up in that stuff. PE ratios and stuff. They're just historical. They're just numbers people pull out a way to give a value or multiple to something. But multiples never really do make that much sense. So it's best not to base your life savings around it.
No, it shouldn't be. It shouldn't be. And what was the Buffett indicator that he always looks at GDP to market cap or market cap to GDP? And if that's
Something
two
like
hundred
that.
percent, there's that disconnect, and that's why
Yeah.
he's mostly cash right now, which is a
Yeah.
really logical move. I see you have some charts loaded up. In the background here. Let's dive in here. Really curious. So you got gold. We're getting ahead of ourselves here. Let's take a quick look at the S&P 500 real quick, Chris.
Sure.
You got to have the audience, hanging on for a little bit and
Yeah.
build that excitement, of course. But let's take a look at the S&P 500. Like, what's the momentum with a bit of a trend change today, of course, but overall downtrend intact.
Yeah, I mean today the markets are kind of all over the place. If we look at the majority of sectors, a bunch of green, bunch of red. It's a very mixed market today, depending on what's going on. But you know, it, Kai, if we look at the longer term picture of the SP 500, this is something that I think a lot of people really need to get a gauge of. So I use Fibonacci extensions for a lot of stuff. It is to me the number one most powerful tool to project forward, which I use for gold, and we'll show it on gold shortly. Where the next resistance and targets are for a particular asset. Now, this is the SP 500 monthly chart, and Fibonacci extension tells us. And if somebody doesn't know what Fibonacci is, they need to go look it up. It's a sequence of numbers that repeat in the universe over and over again. Very, very powerful. But more or less, the COVID low on the SP 500, we rally up to the 2022 market high, and then we come down to this pullback. And Fibonacci tells us based on the run up and the pullback, and we used where it found support, it'll tell us where those next upside targets are. And you and I have talked about this quite often, Kai, is whenever we run up and we hit the 618 level, this is 61% of the previous rally, we're generally going to see the market have a pause. And if the market pauses, and this happens with any asset class, this is just almost like a universal indicator. If we pause at the 618, we almost always go up and hit the 100% measured move, which is the one mark. And so the SP 500 has gone up. It has hit this three times for somewhat of a triple top pattern. And now last month we got rejected. And so this is saying, okay, well, this chart pattern is playing out perfectly based on the momentum, based on the technicals. Now I feel like we're kind of in this spot right here where we've hit this top, we've got this initial pullback, and now I think we're going to go into a multi-wave bear market. The question is how big of a bear market? 20%, 40%, 60%, I don't know. But to me, I'm pretty bearish. So that's what the big picture is showing. Now, if we zoom in on the shorter term, this is where more active traders might find a little more interesting. Is if we take a look at this, we'll just take a look at this 30-minute chart of regular trading hours, and this is again the SP 500. What we saw on Friday was the market gap lower and it sold off and it closed near the lows of the day. And I was telling subscribers, I was like, listen, this is a weekly close bar. This is a bearish sign. Everybody's scared to hold and they're dumping their shares into the weekend. And what does that do? It gives people the whole weekend to worry and stew in their brains, get their emotions going to sell their positions on Monday. And we saw a level of panic selling on the New York Stock Exchange of 10-1, which more or less is saying there's 10 people just selling their shares. They don't care what price they get. They're just hitting the bid. Just get me out, get me out. When this ratio is over 3, which is this blue line, there's panic. And when we close over 8, which is what we did, we almost always see the next trading session have a big gap down. The market will flush out, which is what we saw just yesterday, or whatever day this was. This was March 31st. Everybody panics out. The VIX spiked, the put call ratio spiked. So everybody's buying put options saying this market's falling. They're all betting on falling prices. And they all literally get out at the bottom and panic and put on the wrong trade. And then the market rips higher. And what this does is on the daily chart, it gives us this reversal candle where the market opens lower and it sells off and rebounds. Now, this is futures. So this is showing regular trading hours. The SPY gives us the real price action on the daily chart of how it looks, which is this massive gap to the downside, a little flush out in the morning of everyone finally dumping the rest of their shares. And then, of course, we scream to the upside for a reversal bar, which points to, we should be putting in a significant low here and a bounce. So long-term investors monthly chart, it looks like the music has stopped. Be very aware that we could not see new highs for many years. From a short-term perspective, we're in a downtrend. So, picking a bottom is dangerous, but it does look like we have a short-term exhaustion, oversold low, ready for a bounce for a few more days. I know that was a ton of info and there's 2 time frames there, but that's kind of what we need to focus on.
Chris? Chris?
Damn it, I lost you.
No, back. You're back.
Okay.
You're
Did we
back.
catch all that?
Yeah, the last thing I heard was that was a ton of info. Perfect break. So we'll
Okay,
just
thank God.
continue. I'll have my editor just cut it out. Easy to do. So
All right.
so Chris,
Yeah.
yes, that was a ton of info. The question now I have is like really timing, because it was the end of the quarter as well. Like, how significant was that? March 31st and the Friday before quarter end, option expiry. How do you factor that into the chart moves, and did that have any effect at all?
Yeah, you know what? I haven't looked at quarterly charts forever. Let's just take a look at the SPY, which is the SP 500 quarterly chart. Like the a daily chart has got power. A weekly chart has got a lot more power because it's everything's the whole week wrapped up, and then the close of where investors are on the end of a week. A monthly chart is very, very powerful. I like that. Obviously, chart's having problem loading here, but the quarterly chart is super long term. It's actually such a long term time frame. I try not to look at it too much. I very rarely look at it because a pattern on the quarterly chart takes decades to unwind, and that is like watching paint dry. That is like watching your life go by. So, when we look at it, here from a nutshell, this is sorry, my charting platform's trying to load, but so here we the 2000 market top, we got the 2008 market top, we've got the COVID crisis, 2022 bear market. And so here we are potentially going into a big unwinding event. And I believe we're starting something big enough that we might still see another bar up and to the right for another quarter. But I do believe we're going to go into a much longer pullback, something like 2008, where it's many quarters, or even 3 years, like in the tech bubble. I think there could be a very big unwinding event. And we never know how big it's going to pull back, which is why you just need to follow price, manage positions. And when something does turn around, you either avoid it, get away from it, or take advantage of it. But the quarterly bar is definitely, I think, going to put, shock a few people, probably more so the Fed and economic people, because I think there's more economic data wrapped around quarterly charts than there is. I don't see many people ever talk about quarterly charts from a trader or investor standpoint. I think quarterly is like fundamental Fed, all that news kind of stuff, economic data. So I don't look into it very much at all. But if we
Yeah,
enter a
it's
bear
also
market,
like
just
fund positioning and just over option
yeah,
expiry potentially, things like that.
yeah,
At the end of the
yeah,
quarter, how that was affected, of course. So, no, I appreciate you sharing that and jumping down that rabbit hole here with me. Of course, the follow up question here is like, where did the money go that was pulled out of the S&P? Let's see if we can investigate that together. Of course, we always look at the bond market together and the U.S. dollar.
yep.
We'll save gold for last. But where do you see that money popping up, Chris?
Yeah, well, we've been seeing this more and more frequently. Like for example, obviously we have bonds are starting to move up. We've seen this more frequently. The market has gone in the bond market from a downtrend, a very long term downtrend back from the COVID peak. It has gone in full on topping phase, and then it's gone into a stage 4 decline. Now it is in a sideways, a basing formation. So bonds are trying to build a bottom. And I believe now we're getting into more of a bullish chart pattern where we've got this strong rally, we've got this bull flag pattern, which points to higher pricing going forward. And Fibonacci allows us to get an understanding of where those next targets are in bonds. But as you were saying, we saw money flow out of stocks and they're looking for somewhere to go. And they've really only been going into two spots in the last few sessions, which happens to be bonds. Bonds have had a very strong rally as a defensive play. And the other one has been into the precious metal space. But money is moving into bonds, and I do believe bonds are going to become a very strong play later this year. I think they've bottomed. I'm pretty sure they've bottomed, but they could still trade sideways here for like another 6, 8, 12 months. Just because they've bottomed doesn't mean it's a good opportunity. I like to wait for somebody to actually start an uptrend and be on its way to the moon and then hop on and ride it for imminent kind of returns versus trying to pick a bottom here. You still might not make any return and you might still lose 5 or 10% as it chops around for the next several months as the market tries to evolve. So short term, we're seeing bonds perk up and take some of that money. The other space really just seems to be gold. And I think that's been the play, a big play for anyone who's into commodities for quite a while. It's in a strong trend. It's not letting up. So those are the two pockets that are, I think, on fire right now.
Yeah, us talk about it. We can't shake it. We can't prolong it any. We can't. Yeah, let's talk gold and amazing price action in the gold price. Insane rally over the last 10 days here, and actually 2025,
Yeah,
the
it's been
strongest
huge.
quarter since 1986 was Q1. I picked that up on Bloomberg, so I'll have to fact check that. But why would they lie to us, right? But
Yeah,
plus 19% in Q1. That's an insane move for a pet rock for a 5,000-year-old relic. And
a pet
what do
rock. I
you
haven't
make
heard
of
that
that
one. I
move?
like
And
that.
right, the sloth has woken up and started becoming the hare or whatever it's called in the race with the turtle. It's insane. Make sense of it for us. Like insane move. Is it healthy? And where's the end?
Yeah. All right. Well, let's just zoom back like we did on the SP 500. Let's just jump to the monthly chart really quick. You and I covered this, I think, in our last talk, which is using Fibonacci based on the gold super cycle. I'm a huge gold bug. I'm a huge gold fan, and I love physical gold, and I love miners during a raging bull market, which I think we will come to late this year or maybe next year. But anyway, using Fibonacci extension, we have this huge run up from the beginning of the last gold super cycle in early 2000s to 2011. And then we can gauge based on this pullback where that should be. And if we carry that price forward, you can see gold has done exactly what we wanted. It came up to the 618 sideways. And during this time where gold traded sideways, this is where all the other assets came to life. Nobody wanted the pet rock at that point. They're all like, get me into stocks, get me into real estate. Everything is a bubble except for gold. And then suddenly out of nowhere in the last year and a half or so, gold just shot up and started to take off, which is to be expected. We talked about this, that the 100% measured move is about 2750, and we've gone up and hit that level. So that long-term perspective has been hit, and now we're in what I call kind of like icing on the cake. This last push is kind of the we're getting really close to a major tipping point in the economy, in the equities market. People don't know what to do. They don't trust the banking system. They don't trust currencies. So they start to move to gold. And gold's a pretty small market. It doesn't take much to drive it higher. And this icing on the cake phase is actually what happens just before a pretty major correction. We saw that back in 2010, 2011. We also saw it just before the 2008 financial crisis. Gold had rallied up, hit its measured move, and then suddenly had this shoot up for a couple of months, a few months, just before going into a big correction. So from a long-term perspective, gold has hit its measured moves. As far as I could measure at that point, gold has hit that. Now, if we look at the daily chart where things get a little more intricate here, we can zoom in to find out where the next short-term price target is. And we can do that using a Fibonacci extension on this most recent rally and the pullback. And this shows that we should see gold run to about 3,225. There's another one we could actually draw on a bit longer time frame cycle, from this low to here. And that brings us up to roughly $3,260. So there's still some upside potential in gold. Once you've hit the max major chart patterns, all I can really do is kind of say, okay, with a high degree of probability, I can tell you where the next kind of leg range is. So there's like 2.5 to like 4% upside potential for gold for this next run. And so, I mean, it's not huge, but I mean, it's still a nice move. This is definitely a defensive play. Gold is in favor. It is kind of the best play out of everything else in terms of miners or silver, just because gold is that global barometer that when everybody gets nervous and people who have a lot of money, they want to put it into something that has some stability. And gold is that big, slow. What did you call it? It was like the tortoise.
The
Gold is the
sloth that became
tortoise.
the hare or whatever it is.
Yeah,
Just
the sloth. And so if something moves slow, it means you can put more money to work. If something moves really fast, like miners or silver, and they're all over the place, you put less money to work because it's risky. And so natural investors who have wealth tend to move into gold around the world when they all get nervous, and the world generally gets nervous around the same time. And then if we zoom into one notch closer, this is the 30-minute chart here on the left-hand side. And more or less, we've got a few different time frames here, but we saw panic selling, this spike here. This is New York Stock Exchange panic selling ratio that I have, that I created. And when we have panic selling in the stock market and everybody's ejecting out of their stocks, this chart below is gold. You can see gold during this time. People started to get nervous. Gold shot up and took off as that defensive play. So you ask Kyle, like, where's the money going if it's coming out of the stock market? Well, it shows here people were dumping stocks and gold was shooting higher. So there's no doubt gold was like the biggest. Gold and bonds were the two that money just said, get me into those things. And so that's what we have right now. And it's a little overbought, and gold's pulling back today as we're talking. And it's because it just had a huge percentage move, big for gold. And now it probably needs a little bit of a pause or breather. If you look at the daily chart, it is right at a 618 level. This is a level that it should take a bit of a pause, maybe for a couple of days, and then boom, it can run up and have that 3 to 4% move in a week or two. So that is kind of the long-term view of gold. Think of this as icing on the cake as a long-term investor. We're probably going to see gold eventually. I think we could see gold pull back quite substantially when we have a financial reset, a recession. I think there'll be a much better opportunity to buy more gold. Load up with a bunch of pet rocks, as you said, and then after that, that's when gold miners and silver will become, I think, a great opportunity. And the monthly chart, Kai, if I was to just kind of show you what I kind of expect with the price of gold, is I believe we're gonna go a little bit higher, but I do think we're going to see gold have a fairly decent correction. And the last time we saw gold pull back from a recession was 34%. So we could see, gold potentially come back down to this 22, 24 range. You never know. It could even come right back down to this significant level of 34 like it did last time. I know you don't want to hear that. And probably a lot of other people don't want to hear that. But this is typical price action. This pullback is the same as the 2008, and you need these corrections in order for it to continue the second half or the next wave of the journey to the upside. So um, I have this question. I did a mentoring session with a whole bunch of traders and investors last week, and they're all like, can I buy gold now? I'm like, you can do whatever you like, but I believe it's like nosebleed pricing. I think there's going to be an abrupt reversal. It's going to become an awesome opportunity if you don't get caught up in this selling and holding things that are going to drop, like individual stocks, which are a little more volatile. But um, I'm very bullish on gold. I think we're going to see 5,000, 8,000, dollar gold in the next few years. We just have a hiccup to get through on the way there.
Yeah, Chris, I'm in Zurich right now. European Gold Forum is happening. A lot of gold producers here. In my meetings tomorrow with them, should I tell them that they should start hedging their positions and maybe even forward selling some gold at the current levels? And again, not financial advice or anything, but would
Yeah.
that be the prudent and logical thing to do based on what you're saying?
I feel like it. I mean, the charts, everything, even to me, the economic data. When I look at economic data, and I show this in some of my presentations because I do cover it, the economic data to me has already turned a corner. Now, not enough for everyone to be like, "Oh, we're in a recession," but to me, it's doing. All the signatures are there that the economic data has already shifted, and I think selling gold and probably hedging is a good idea for somebody who carries a crap load of gold and their business depends on it. Sometimes it's better not to make a bunch of money. It's better to just kind of hold your wealth and hold your position than it is to risk losing, 20 or 30% of all that, just because you want to make more. So, I remember what gold company was it? Literally right at the peak of 2011. It was like Gold Corp or somebody. They were like the biggest hedgers of gold, and they're finally like, you know what? We're not hedging anymore. I can't remember which gold company it was. They literally unhedged right at the market top, and they took a beating. Like, this is the problem, is a lot of companies and managers and businesses and stuff, they don't understand actually the economic cycles and price cycles, and so they get caught on the wrong side of the markets and they make some of the worst possible decisions at the worst time just because they don't know better. I mean, this is what I live, so I see things very clearly. And but if you could take that and apply it to a business, like as you just said, like, hey, maybe you guys should like hedge some of this. You don't have to do it all, but a little hedge is a little bit of insurance to save you from potentially a lot of pain down the road. Um,
Yeah, if
I
somebody's
don't.
willing to sell you a $3,100 gold hedge right now, anyway, to be honest, that's
Yeah.
like based on that move, right? But that's a different discussion. Chris, before I let you go, we got to talk silver real quick because silver has been lagging. While gold's been rallying a percent or so a day, silver has been pretty much flat
Mhm.
in comparison. Especially also this morning, I woke up, gold was green, silver was red. Um, what do you make of silver price action these days, Chris?
Yeah, well, silver is getting close to its 100% measured move. So I've got the daily chart, or sorry, this is the monthly chart here. And I just kind of drew Fibonacci extensions on here so you can get a gauge of where I think silver could go. So we have the 2000, the 2000 low, the 2020 low, and then it's pulled back. And we've hit this 100% measured move, or sorry, this 61% measured move. And now it's working its way up to this $36 resistance area, which if we draw a line across the chart, you can see it's close to some significant highs in the past. It was a significant pivot low here, a couple highs through here. So to me, silver is very close to a very violent topping phase. These three surges this is the monthly chart. This push up and sharp pullback, another push up and another sharp pullback, and now we're on the third one. I call it three surges to a high. I think there's another term for it. It's just what I've always called it, but it's usually a very bearish sign. Usually the market has a huge correction afterwards. So again, I think silver carries a lot of potential downside risk at this point versus gold. Gold will hold its value a lot better. Silver, again, for the 2008 financial crisis, I think it pulled back around 65% or 60%. Usually it's going to be at least almost double of what gold is. So silver still has upside, not a lot. It's got maybe a buck 50 to the upside. Percentage wise, it's a lot more than gold, but it is kind of like carrying you're walking through a landmine. In one day, you could give it all back, blink. Silver moves very quickly. So I don't think there's a lot of upside potential in silver, like for the risk. I think there's a lot more downside than there is upside potential here.
Okay. No, fantastic. I really appreciate that analysis, Chris. And maybe last question: what's your favorite chart out there right now? What's Chris buying? What's Chris excited about?
Nobody wants to know because we're sitting in cash right now. I mean, we're sitting in a BIL position, which is just a short-term treasury note. We collect our daily interest, our monthly dividend payment. We just get to avoid the market chaos. From a long-term perspective, if you're a long-term investor, we're actually still long the market. But our shorter-term strategy is saying, hey, there's mixed markets, mixed signals everywhere. It's best just to sit on the sidelines until we get a clean new buy signal to get long the stock market, or we get a potential inverse trade to bet on falling pricing, which I think is a few months away. And maybe if bonds give us a signal, we'll get into bonds. But right now, as a long-term investor, we're still along the stock market, knowing the end is probably in, and we're just waiting for our position management and the long-term trend to change, and then we'll get out. Short-term traders, we're in cash. I'm expecting a bounce that could last several weeks, potentially even a month or two. And then after that, the big question is it a bounce or is it the start of a rally? I feel like it's going to be just a bounce, and then we're going a whole lot lower, which means bonds could become a trade in a month or so. Potentially the US dollar index could become a trade. Or maybe we have to go back to cash, or depending how the markets unfold, it could be an inverse ETF. So, the markets are always changing and evolving, and where money's flowing between various assets tells us how we need to attack the market. And of course, you got to wait for those to unfold before I can give you that guidance. But right now, short-term traders, we're sitting in cash, and we have been for like a month and a half or so. We got out near the highs because the market was saying something's changed, get out. The trend has actually ended. And so we've just watched this, 10% collapse from the sidelines, learning and covering the importance of position management and not falling in love with investments. And man, there's a lot to be said. If you can do those things, you can be highly successful. It just takes time. Time is money.
No, absolutely, Chris. And a lot of people can learn more from your work, of course, at the technicaltraders.com. What else are you teaching in your? I know you offer courses and other things, and you mentioned
Yep.
you've just held a course here recently. Toot your own horn a little bit here, Chris.
I do have some courses on if you have trading strategies that you have in your head. I do have a course, Trading Strategy Mastery, which you can document it. This program, more or less, there's this mini course. It's only about 3 hours, but it helps you document your strategy, turns your idea into something that you can hand somebody else. You should be able to give your strategy to somebody who doesn't know how to trade. And if they can execute it and every little detail has been fine-tuned, then you're set. And this is the thing, everybody who takes it realizes the strategy that they thought they have and that they like and they use and that makes money. When you actually put it down on paper, you realize you're missing a lot of info. It usually does not work. And it takes months or years to refine that idea you thought worked, doesn't work, and to make it work. So I think that's the most sobering thing you could do. I also have a course called Trading as Your Business. And if you treat trading like a business and manage your positions, which is like your P&L statement, your expenses and stuff like that, you can do very well. But as soon as you turn something into a business, it usually becomes boring and you're not swinging for the fences, trading all kinds of crazy stuff. People don't like boring, and they don't like to know that the strategies they thought they had don't work. So there's a fine line. It's like you either follow somebody and just go with it, or you go down this path of realizing the market is very difficult, and it requires a ton of self-discipline and time to master.
Yeah, pain threshold needs to be high, absolutely.
Yeah,
But you invest a lot of money and you learn a lot, but it's going to cost you a lot of money. So,
exactly.
no,
Yeah,
fantastic, Chris. What a wonderful conversation. Always appreciate you coming on. Fantastic insights. Thank you so much for taking the time. Really, really appreciate it. Thank you so
always a
much.
pleasure. Yeah.
And to everybody else, thank you so much for tuning in here to Soar Financially. I hope you enjoyed this conversation with Chris Vermeulen. If you have, please go check out his website, of course, but also make sure to hit that like and subscribe button here on this channel. Helps us out to bring guests like Chris on, of course. And we're tremendously appreciative of sponsors of today's video, Yukon Metals. Go check them out as well. Make sure to pay attention to the disclaimer as well. Of course, this has been sponsored, so make sure to cover that and take that into consideration. Really appreciate you watching. Thank you so much. We'll be back with lots more here on Soar Financially. Take care.